my thanks to the ABA for inviting us to say a few words on behalf of King & Wood Mallesons to introduce the most distinguished keynote speaker. For many of us, this week marks the end of the financial year, and it's a week in which interactions with the banking system are wont to peak. On Monday, I found myself needing to disperse funds quickly to sundry creditors, worthy causes, and the ATO. And thanks to the marvels of the NPP, I was soon drawing on my account with a variety and at a rate that might have challenged the assumptions of the most prudent liquidity test. And then a strange thing happened. An email arrived from a gentleman kindly requesting a payment by cheque. Such was his convenience. Being an obliging sort, I found the old book, I filled my fountain pen, and in his favour I drew the cheque. Lacking an envelope, I then went to a post office where I bought one, using a banknote taken from my leather wallet. Now, none of that was chargeable, as to say. Done with my personal business, I went back to ponder the legal problem of the day. How might the law of restitution apply to mistaken cross-border dealings in a tokenised carbon credit? Such is the lot of an old banking lawyer and how it touches on the issues of the day. Changes in liquidity risk, changes in payment techniques, changes in the use of cash, the digitisation of assets, climate risk. The pace of change is, of course, extraordinary. But at the same time, old habits can take a long time to die. And as change is embraced or resisted at different rates, the variety of practices grows and the catalogue of risks expand. The old risk lingers as much as the new ones are born or magnified. And in all these practices and throughout these changes, the only constancies are the lawyer's tendencies. Too many human beings who misunderstand, who miscalculate, or who deceive. And the only constant antidote to those failings, in my view, is accumulated prudence that's born of long and varied experience. Now, you may collect that prudence in many places: in banks, in advisory firms, in research faculties, in industry associations. But the most powerful place to collect it is in an entity that can survey the whole market and, armed with that knowledge, is empowered and ready to intervene appropriately should the circumstances demand. We are very fortunate in this country to have regulatory institutions that fulfil this role, and we're even more fortunate today to have with us a man who epitomises that role. 30 years' experience in the Australian Treasury, head of the Secretariat to the Financial System Inquiry in 2014, recipient of a Public Service Medal in 2019 for his services to the financial system, and since October 2022, the chair of the Australian Prudential Regulation Authority. Ladies and gentlemen, please welcome Mr. John Lonsdale.
Thanks very much, Ian. Thanks for that kind introduction. And good morning. It's great to be here in Melbourne attending the ABA conference once again. Resilient and ready, Anna. I really like that. It's a great theme. For the next 30 minutes, I'm here to talk to you. But as APRA chair, I actually do a lot of listening in my job. So I meet regularly with a lot of boards, with a lot of CEOs, major banks, regional banks, credit unions. I meet with industry associations like the ABA. I meet with Treasury, meet with international regulators, a lot of people. And those discussions are an opportunity to provide updates on APRA's assessments, the risks that we're seeing, what we're doing. But it's also a chance to hear from those that we supervise and those who are accountable to see the environment and the impact of our regulatory decisions. Over recent months, APRA's heard a consistent message from the banking sector that the industry has become too risk averse and that some in the community may be unfairly missing out on services, including access to credit. In summary, there's a view that the regulatory pendulum has swung too far towards safety at the expense of dynamism and risk-taking. The narrative suggests that regulators, including APRA, should consider loosening constraints to boost the flow of credit, especially for new business ventures. The question of whether or not the current regulatory settings remain appropriate as economic conditions evolve is a legitimate matter for debate. No one wants unnecessary red tape, and nobody wants more regulation to solve every problem. Within APRA, we constantly ask ourselves these types of questions, and not everybody in the room has the same view. It's also not a debate that's confined to Australia. New Zealand regulators were recently said to be stifling competition to the big four banks, while bank lobby groups in the US have even gone so far as to run television advertisements opposed to the Basel III reforms during major sports broadcasts. The case put forward here in Australia by those who say it's time to rethink regulatory settings for banking contains some good points, and they are worthy of reflection. But it also strikes me that the argument to date has been quite one-sided. It's been heavily focused on the cost of financial regulation and paying little attention to the benefits or why it actually exists. There's a strong emphasis on profit margins, return on equity, credit growth, but few, if any, mention the safety of deposits, protecting vulnerable people from unmanageable debts, and the potential cost to taxpayers if a banking crisis unfolds. To be clear, my purpose today is not to argue that APRA's prudential framework is flawless. It's certainly not, which is why we are constantly reviewing and fine-tuning our settings, such as the current consultation on liquidity and capital requirements. Rather, I want to defend the importance of a strong and stable and resilient banking system, not only to protect the community and taxpayers, but also to support a thriving economy. If we wind back the clock to March last year, the nature of debate about bank regulation was very different to what we see today. The global financial system had been shaken by a bank crisis that began in the US before shifting to Europe. Urgent and significant intervention by American and Swiss governments and regulators was needed to bring it under control. As a mid-sized economy, heavily dependent on access to international funding markets, Australians watched closely as events overseas unfolded. We're well aware of the contagion risk that exists in an interconnected financial system. While it would be inaccurate to say the crisis had no impact on these shores, it was minimal, fundamentally due to the strength of the most critical component of bank resilience, and that is trust. At a time of global skittishness, APRA, the government, the banks and commentators could confidently assure the community that our banking system was among the strongest in the world, that our banks had unquestionably strong capital levels that put them in the top quartile globally, and that our prudential framework was super equivalent to international standards in a number of areas, including, very importantly, the management of interest rate risk in the banking book that sparked the Silicon Valley Bank collapse. These regulatory settings are not an accident. They are the product of deliberate decisions by governments and regulators in response to events, crises and inquiries over many years. These include the 2019 Royal Commission, the Financial System Inquiry in 2014, and chiefly the global financial crisis in 2007 and 2008. A decade and a half on, the true cost of the GFC remains hard to pin down, especially because it can't be measured in dollars, euros or yen, but also in jobs lost, homes repossessed and lives destroyed. The internationally agreed Basel III reforms that emerged from the GFC laid the foundation for APRA's modern prudential framework for banking, contained higher capital and liquidity requirements, as well as a greater emphasis on risk management, governance and accountability. The Financial System Inquiry pushed APRA to go further in building a more resilient banking system. Most significantly, the inquiry's final report recommended APRA require banks to increase capital holdings to what I mentioned before is an unquestionably strong level. The FSI's reason for this was not purely about minimising the risk of a bank failure or other financial crises. It pinpointed the importance of Australia's banks being internationally recognised as financially sound to ensure continued efficient access to international funding markets. It found that while making the banks unquestionably strong would cost more, the cost was very low in relation to the risk that it was mitigating. It also found that unquestionably strong capital levels reduce moral hazard in the system by lowering the likelihood that government support would be needed in the event of a financial crisis. In a country that hasn't experienced a significant bank failure in almost 35 years, it's easy to forget or become complacent about their impact on the economy and the community. When the Pyramid Building Society fell into liquidation in 1990, the Victorian government had to repay $900 million to affected depositors, which it funded with a 5-year levy on fuel. In other words, taxpayers footed the bill. Memories of bank failures and expensive taxpayer-funded bailouts are fresher overseas. In analysis undertaken in 2013, the Federal Reserve Bank of Dallas conservatively estimated the GFC cost the US economy the equivalent of 40 to 90% of GDP. The IMF figures show that between 2007 and 2013, government debt rose sharply across the world, more than 20% in Italy, 30% in Spain, 40% in the US and UK, and 80% in Ireland. With the Basel Committee on Banking Supervision estimating that the median cost of a financial crisis is more than 60% of a country's annual GDP, APRA is understandably keen to shield Australia from such an outcome. But should one occur, our banking system is well prepared. The results of APRA's 2023 bank stress test found that Australia's banking system was well placed to remain resilient in a financial crisis. In a hypothetical scenario with high inflation, unemployment rising to 10% and house prices falling more than 1/3, no banks breached their prudential requirements on capital and all retained sufficient liquidity. And banks continued to provide credit to households and businesses. It's a good news story that should give the community a lot of confidence in the resilience of the banking system in the face of a major financial crisis. But what if the strength of our banks was in fact questionable? To put this to the test, we reran the stress test using the same hypothetical scenario, but this time assumed that the banks actually started from capital positions that they had before unquestionably strong. What we found was that several large banks in this alternative scenario would fully deplete their capital buffers and either breach their prudential requirements or go close to it. If this were to occur in real life, the best case, this is the best case, is that the banks would need to rebuild their capital positions over time. This would likely involve a restriction of the supply of credit to households and businesses and potentially exacerbate any economic shock. The worst case is we would see one or more bank failures which would either cause a severe credit crisis and recession or would require taxpayer-backed support of the banking system. These results highlight why APRA's focus is broader than the strength of any one bank. It's the strength of the entire system because it's the system that underpins the Australian economy. The results also underline why, after spending more than a decade building the resilience of the banking system, we have no intention of dialing it back and weakening these gains. That doesn't mean we intend to keep ratcheting up the settings or that the current settings are frozen in time, nor should it be assumed that safety and stability are our only concerns. APRA supports less complexity and more proportionality where it is safe to do so, and we're open to fine-tuning our regulatory settings when appropriate. This isn't a new stance. Consider our macro-prudential settings, which are constantly assessed, periodically adjusted in response to changes in the operating environment. An examination of those settings since 2014 shows that APRA has introduced and later removed limits on interest-only and investor lending, removed the serviceability floor, adjusted the serviceability buffer twice and lifted the counter-cyclical capital buffer to where it is today at 1% of risk-weighted assets. Our focus is increasingly about maintaining the strength of the banking system, and that maintaining's important. While this is challenging in a moving operating environment where new risks emerge and existing ones evolve, we are transitioning to a more targeted approach focused on fine-tuning existing settings. Some of that fine-tuning will come in the form of changes designed to make our prudential framework simpler, less burdensome to comply with, and more proportionate. A good example is the recent release of the finalised guidance to accompany our Prudential Standard on Operational Risk, CPS 230. Although 230 rationalised 5 prudential standards into one, we're acutely aware of the challenges the new requirements create for some parts of the industry, especially at the smaller end. As a result, the finalised guidance gives more time for smaller entities to comply with parts of the standard, modifies or entirely removes aspects that were causing industry confusion, and provides greater transparency on our intended supervisory approach to help entities plan ahead. Whether recalibrating parts of the existing framework or introducing new policy, our considerations go well beyond the financial safety and simply minimising risk. A safe financial system means the likelihood of less disruption from failures, which is more conducive to investment choices. As the government's latest statement of expectation spells out, APRA cannot and should not seek to guarantee a zero failure rate. Rather, we are charged with balancing safety with a range of other factors, including competition, contestability, and neutrality. With regards to banking, we're also tasked with facilitating the flow of finance to support strong, sustainable, and economic growth. This last point is where much of the recent debate has been focused. Specifically, we've heard concerns about regulatory requirements impeding the ability of households and businesses to access loans, and that banking services, especially home loans, are increasingly the preserve of the wealthy. Looking at the data that we collect across the banking sector, the story is more positive and nuanced. In the 12 months to April this year, housing growth grew by 4.5%. That's housing credit growth, while business credit grew by a touch under 7%. While both figures are lower than they were during the peak days of the pandemic when interest rates remained at record lows, they are historically robust figures that remain above pre-COVID levels. Is it getting harder for home buyers to get sufficient credit to buy homes? Yes, it is. The primary reason for that is a rise in house prices since the start of the pandemic of 35% during a period where wages growth has been 13%, combined with a rising cost of living and an official cash rate that's risen over 400 basis points. APRA's serviceability buffer also plays a role in reducing borrowing capacity, and that has led to calls for us to lower it. If we believe economic conditions warrant changing it, we will do so. However, it's important to understand that the purpose of the buffer is not only to reduce credit risk, which protects the stability of the bank and the safety of deposits. It protects people. So if some borrowers can't get access to the amount of credit they want, while others have been given loans that they can't afford, what is the answer? APRA's solution has been to grant the banks the discretion to offer loans using exceptions to our guidance on mortgage serviceability in cases where they are confident the borrower has the capacity to repay the loan. And this leads me to the final point I wanted to make before wrapping up. APRA's Prudential framework is prescriptive in some key areas: capital, liquidity, governance frameworks, information security, hygiene requirements. But when you look at the totality of the standards that we've got, most of the framework is principle-based, which creates significant room for banks, as well as insurers and superannuation trustees, to run their businesses the way they want. In banking, that means the ability to set their own business strategy, pricing and risk appetite. At a time when banks are well provisioned, seeing lower than expected losses, there is ample scope for banks to rethink their business strategies, lift their risk appetites if they want in some areas, and adjust their pricing. Ultimately, a bank's commercial success is far more a function of the decisions its board and management make than it is a reflection of the broader financial regulatory framework. In saying that, we recognise that regulation can create a financial impost, especially among smaller entities, and we look forward to working with our colleagues in the CFR on the recently announced competition inquiry to see if those challenges can be addressed in a way that does not undermine banks' resilience. The challenge will be to ensure we preserve the safety of our system while also promoting the opportunity for maximum innovation and dynamism. The concept of a regulatory pendulum is not a new one. Back in 2005, you can tell I like history, the Australian government created a regulation task force to review red tape across the entire economy. The task force's report was a landmark report, released a year later, concluded, and I quote, "There was too much regulation, and in many cases it imposed excessive and unnecessary costs on business." The report then recommended 100 reforms to relieve the regulatory burden on Australian businesses, including banks, insurers and superannuation trustees. A common theme among submissions from the financial services industry, the report noted, was a belief that APRA and ASIC were overly risk averse. Yet within 2 years, the GFC was upon us, and it became clear that financial regulators globally hadn't been risk averse enough. The weight of that realisation caused the pendulum to swing towards the stronger regulatory settings we have today. It doesn't follow that regulation is always the answer, or that more rules create better outcomes, but episodes such as the GFC and the recent Royal Commission are reminders of why it's necessary in the first place for appropriate prudential regulation. APRA is actively seeking ways to make our regulatory framework simpler and more proportionate and easier to comply with, but we won't take risks that compromise stability or the ability of our banks to keep credit flowing to support the economy. With last month's federal budget forecasting a weaker global domestic outlook, with risks in the environment increasing, now is not the time to wind back the clock on financial safety. Thank you very much, everybody.
Okay. If anyone's got any questions I'd like to ask of John, just throw your hands in the air, grab the attention of the microphones and move around the room. I'll start with one. GFC, fascinating.
We're sitting, standing?
You can stand. We're standing.
Okay.
I need to use these things here. Subprime loans, toxic loans, that sort of stuff. It was a mess of the banks making. There's a real chance these days the great threats could come externally, cyber threats and the like. We've seen some significant data breaches in non-banks and in Australia recently. Do you guys have a look at that? What's your assessment of where we're at in terms of, we're going to dive deeper into it tomorrow in a session dedicated to it, but what's APRA's view on the cyber resilience of Australian banks at the moment?
So cyber risk and operational risk is a big focus for APRA. We have a standard, you'll be aware of it, we speak in numbers 234, it's about 5 years old, this standard. We've done something with that standard that we've not done with any of the other standards, and that is we've required an independent review of every regulated entity against that standard. And we published some results in 2013. I think the basic message, Adam, is there's more work to do. So we highlighted 6 gaps. We want entities to better understand where the critical assets are, where their information, the important information is actually stored. Basically have a plan if something goes wrong, make sure we've got the controls in place and make sure we've got reporting. So there's a whole range of issues that we've talked about thematically. Where we identify entities that have got particular problems, we lean into that, so there'll be intensified supervision as well. So it's a big focus for us. Operational resilience, I think, is hard on the back of cyber. It's different, but it's related. And we've recently released CPS 230 and some guidance. And the core of that, I guess, is not just about thinking about the controls, the information, but actually extending that to third parties. So when you're outsourcing, actually think about that. Think about what they're doing, the controls, have you got that in place? So it's a big focus for us, and you can see through some of the shocks that big entities, not just in the financial services industry, but broader, have experienced. It can cause a lot of damage.
CPS 230, something else we're drilling down into during this conference. One more quick one. You're releasing your next corporate plan in October, including our policy and supervision priorities for the following year. Can you give us any tasty little teasers, any tidbits on insights into what we can expect from the corporate plan in October?
Well, it's going to look and feel a lot like the old corporate plan because we release it in 4-year chunks. So I think the key things are we are constantly monitoring the risks. So that is a big part of what APRA does all the time. So, we talked about operational risk, but geopolitical risk is a big one that's really changed in the last couple of years. So we're always monitoring that. There are a whole range of lessons that have come out of the SVB Credit Suisse work. We've completed the work on IRRBB, but we're having a consultation on liquidity. We've got another one happening on hybrids as well. So there's that stream of work that will happen as well. We're doing a lot on the super space. We'll release another performance test result in August. And on insurance, there's a big focus there on insurance affordability. So there's a lot in there. The other thing that we'll do, I should add, that does look different this year to provide more transparency is we are linking the corporate plan to actually the activities. So people care less about APRA's policy and supervision. People just see APRA. So what is APRA doing? And how do those doing bits actually link to the key priorities that we identify? So hopefully that will give more transparency on our work.
Fantastic. Quick audience question here and we'll be done. What would you like to ask?
Mr Lonsdale, CPS 230 has a requirement for APRA-regulated entities to assess their level of concentration risk, but the guidance doesn't elaborate any further. Could you share some thoughts on APRA's expectations, please?
Well, thanks for your question. This is a vexed issue because the previous guidance that we consulted on actually had a lot of detail in it. And one of the big pieces of feedback that we got was there's too much detail here. This sets a new standard. We don't want any of that. We want actually the standard to apply and we want flexibility on how we administer the standard. That was the key feedback that we got. So I'm loath to dive in and tell you, other than the requirements are pretty clear, I'd say, in 230. But thank you for your question.
And thank you for your presentation. Please give John a big round of applause. Always great to hear from you, John.
Thank you.
Chair of APRA.